Hi, my name is Christopher. Welcome to this journey through accounting. Today we are going to study the chapter, which is Recording Transactions. In this chapter, we'll explore the step-by-step process of documenting and recording financial transactions. You'll learn about source documents, journals, ledgers, trial balances, subsidiary books, error rectification, and both adjusting and closing entries. By the end, you'll understand how accurate transaction recording forms the backbone of the accounting cycle. Course Overview. This slide introduces what we'll cover. Recording transactions is the first major skill in accounting. The learning objectives include using source documents, creating journal entries, posting to ledgers, preparing trial balances, and correcting errors. It also emphasizes adjusting and closing entries as part of the cycle. Recording transactions is essential for accurate financial statements and for reflecting the true financial position of a business. What you'll learn. Here, we get a clear list of outcomes. You'll learn how to identify source documents, post journals and ledgers, and prepare trial balances. The chapter also covers spotting and fixing errors. By the end, you'll be confident in handling adjusting and closing entries. These skills are the foundation for more advanced accounting tasks later. Why it matters. This slide explains the importance of the topic. Accurate recording ensures financial statements show a true picture. Without correct recording, even advanced analysis would be flawed. Errors at this stage create ripple effects throughout accounts. This is why mastering transaction recording is considered the backbone of accounting practice. Source documents in accounting. Source documents are the evidence behind every transaction. Examples include invoices, receipts, purchase orders, and bank statements. They provide legal proof and establish an audit trail. They also help verify accuracy and support tax reporting. In today's world, electronic documents like e-invoices are also widely accepted. Source documents, practical application. This slide shows the process. Documents are collected, verified, classified, recorded into journals, and filed. Each step ensures accuracy and transparency. Filing makes audits possible and keeps historical evidence. In the digital age, filing also includes electronic storage and retrieval. Journal entries. Journal entries are the chronological record of transactions. Each entry contains the date, accounts debited and credited, amounts, and narration. They can be recorded in general or special journals. The double entry rule ensures that total debits equal total credits. This balance is critical for financial accuracy. Journal entries. Examples. This slide makes journals practical. Example 1, equipment purchase, debit equipment, and credit cash. Example 2, services provided on credit, debit receivables, and credit service revenue. Example 3, prepaid rent, debit prepaid rent, and credit cash. Each entry also includes narration for clarity. This reinforces the importance of clear explanations in accounting records. Ledger posting. Ledger posting transfers information from journals to accounts. Each account has its own section, where debits are on the left and credits on the right. Running balances are maintained after each entry. Ledgers summarize transactions by account type. They form the backbone for preparing financial statements. And ledger posting. T accounts. T accounts are a visual form of ledgers. They make it easy to see the flow of debits and credits. Posting involves identifying accounts, recording dates and references, and updating balances. The result can be debit, credit, or zero balances. T accounts are especially helpful for beginners to visualize accounting flow. Trial balance preparation. A trial balance is prepared after posting to ledgers. It lists all accounts and their balances to check accuracy. The main purpose is to confirm that total debits equal total credits. It also helps identify certain errors in bookkeeping. However, some errors may still go undetected. Trial balance, format and example. This slide shows a sample trial balance. Debit accounts include cash, receivables, and expenses. Credit accounts include payables, revenue, and capital. The totals of both sides must match. A balanced trial balance confirms mathematical accuracy before adjustments. Subsidiary books handle repetitive transactions. These include sales journals, purchase journals, cash receipts, and cash disbursements. Each focuses on one type of transaction to reduce workload on the general journal. Subsidiary books save time and increase efficiency. They are common in larger businesses with high transaction volumes. Subsidiary books, benefits and process. Here we see their advantages. They allow specialization, reduce general journal size, and improve internal control. Daily recording and periodic totaling make them systematic. Totals are posted to control accounts in the ledger. Individual transactions are posted to subsidiary ledgers like customer accounts. Even with software, understanding this manual process builds a strong foundation. Rectification of errors. Errors are inevitable in accounting. Types include omission, commission, principal, compensating, original entry, and reversal errors. Each type affects accounts differently. For example, recording repairs as equipment is an error of principle. Identifying errors is key to maintaining accuracy. Rectification of errors. Methods. This slide explains correction techniques. If discovered immediately, the original entry is corrected directly. If later, journal entry corrections are made. If trial balance doesn't tally, a suspense account is used. Example: wrongly debiting equipment instead of repairs is corrected by reversing the error. These corrections maintain an audit trail. Adjusting entries. Adjusting entries are made at the end of a period. They update accounts for accruals, deferrals, and estimates. Common adjustments include accrued expenses, accrued revenues, prepaid expenses, and unearned revenues. These entries ensure adherence to the accrual principle. Without them, statements would be misleading. Adjusting entries. Examples. Examples clarify the concept. Depreciation allocates asset cost over its useful life. Accrued salaries record wages earned but unpaid. Prepaid insurance is reduced as it expires. Unearned revenue shifts to earned revenue once services are delivered. These adjustments align records with economic reality. Closing entries. Closing entries reset temporary accounts for the next period. Revenues, expenses, and withdrawals are closed to retained earnings. This ensures fresh balances for the new period. The process has 4 steps: close revenue, close expenses, close income summary, and close withdrawals. After this, only permanent accounts remain open. Closing entries. Process. This slide breaks down the 4 steps with journal formats. Step 1 closes revenues into income summary. Step 2 closes expenses. Step 3 closes income summary into retained earnings. Step 4 closes dividends or withdrawals. This ensures proper flow from temporary to permanent accounts. Summary: the accounting cycle. The final slide reviews the cycle. It begins with collecting source documents and ends with closing entries. Each step builds logically on the last. Adjusting entries ensure accrual basis is followed, and rectification prevents misstatements. The key takeaway: accurate recording builds a reliable foundation for financial reporting. Mastering this prepares you for advanced accounting topics.